$1.77 trillion. The largest initial public offering in all of human history. But this moment has nothing to do with rockets, satellites, or even outer space. This is a masterclass in how systemic wealth rewrites its own rules to survive. Wall Street just quietly erased its oldest safeguards to guarantee this happens. And the most alarming part? Your retirement account is about to be forced to buy it. Welcome to Finalystic Media. Today, we decode the mechanics of the SpaceX IPO. To understand the loophole, you need to start with the raw, uncomfortable numbers. SpaceX filed for a public listing targeting a valuation of $1.77 trillion. For context, only 3 American companies have ever traded above that threshold: Apple, Microsoft, and Nvidia. SpaceX wants to join that group on day one. SpaceX generated $18.7 billion in full-year revenue for 2025. That means the asking price is more than 100 times its annual revenue. They are also reporting a $4.9 billion net loss for the same year. So, how does a loss-making company justify a $1.77 trillion price tag? By absorbing XAI in February 2026, creating a $1.25 trillion base, then claiming a total addressable market of $28.5 trillion. They are raising $75 billion from public investors in this single listing. But that $75 billion only represents about 4.2% of the company. The remaining 95.8% stays tightly locked in private hands. And that tiny public slice is where the entire system fractures. When an asset becomes this large, it becomes structurally impossible to ignore. Major indexes like the Nasdaq 100 define the benchmark for the entire technology sector. If the largest tech company on Earth is not in the index loses credibility. So what happens when the biggest asset in history cannot qualify under the old rules? Wall Street does not reject the asset, it simply rewrites the rules of the game. Historically, new companies had to season for up to 3 months before index entry. This buffer existed for a reason. It let the market establish genuine price discovery. In March 2026, Nasdaq introduced a brand new mechanism. They called it Fast Entry. Effective May 1st, any mega-cap IPO can join the Nasdaq 100 in just 15 trading days. They cut the buffer that protected everyday investors. Gone, erased, done. But the seasoning period was only the first hurdle. The second one was bigger. The old minimum free float rule required 10% of a company to trade publicly. SpaceX is only offering 4.2%. By the old rules, they were locked out. So Nasdaq did not adjust the rule. They engineered a massive loophole around it. They carved out a fast entry waiver specifically for companies hitting top 40 valuation territory. Nasdaq was not alone in feeling the pressure. Other index providers began to bend too. S&P 500 has historically required 12 months of trading and GAAP profitability. SpaceX posted a $4.28 billion GAAP loss in the first quarter of 2026 alone. And despite intense corporate lobbying, the S&P 500 completely refused to bend. They are enforcing their strict 12-month seasoning window and their core profitability test. Meaning, while Nasdaq automatically buys the top, the S&P sits completely insulated. FTSE Russell is also consulting on relaxing its own 5% float threshold. Why is the entire global financial infrastructure bending over backwards for one company? Because index providers earn billions by licensing their data to fund managers. If your index excludes the biggest company in the world, the fund managers leave. They cannot afford to be irrelevant, so they delete the rules to stay relevant. But these rule changes carry a deeply alarming mechanical consequence. A mechanic called forced liquidity, the ultimate systemic wealth machine. To understand forced liquidity, you need to understand how passive investing actually works. When you buy an ETF inside your 401k, you are not choosing individual stocks. You are delegating that decision entirely to an algorithm tracking an index provider. Over $527 billion tracks the Nasdaq 100 index alone. When an index adds a company, every passive fund is mathematically forced to buy it. They do not look at the valuation. They do not care about the fundamentals. If the index says buy, hundreds of billions of dollars automatically execute the trade. This creates guaranteed, blind, mechanical demand on a scale never seen before. Analysts estimate this forced buying at between $15 and $30 billion, all concentrated into a tiny window of days, all chasing a 3% float. But here's the catch. To buy SpaceX, these funds need cash. Where does that cash come from? Forced selling of everything else in your portfolio. Passive funds will automatically liquidate billions of Apple, Microsoft, and Nvidia shares. They are selling your existing holdings to fund a position you never chose. And remember that tiny 4.2% float we discussed? Nasdaq's new rules include a weighting multiplier specifically for low float stocks. They treat SpaceX as if it has 3 times its actual tradable float. This amplifies the forced buying pressure into an impossibly narrow supply of shares. Billions of dollars, chasing a restricted, tiny pool of publicly available equity. It is a wealth transfer mechanism engineered directly into the market's own architecture. If the S&P 500 eventually capitulates, it unlocks another $10 trillion in tracking assets. This is not a free market finding a price. It is engineered systemic inclusion. It guarantees demand, bypasses traditional safeguards, and insulates the asset from failure. Which brings us back to the core philosophy of this entire channel. We have talked extensively on this channel about the hard work myth, the illusion that trading your time for a salary creates real, lasting wealth. The SpaceX IPO is a live, real-time proof that labor mathematically cannot scale. You operate under a rigid set of rules designed to extract your time and your output. You have minimum hours, maximum salary caps, and fixed, non-negotiable tax brackets. True systemic wealth operates in an entirely different reality from that one. When you build or own an asset of genuine structural significance, the system literally bends and adapts to ensure your asset succeeds. They did not ask the $2 trillion asset to follow the 10% rule. They deleted the rule so the asset could flow unimpeded into the global plumbing. This is why the transition from labor to ownership is the only genuine escape. Whether it is equity, tokenized real estate, or scalable digital infrastructure, you must own the systems that benefit when forced capital flows occur. Because while your wages flatline, the top fraction of 1% engineer liquidity. They are creating assets that legally mandate index funds to purchase them. It is the ultimate monopoly. And it happens in complete legal broad daylight. But there is a darker layer to this particular IPO setup. A trap. A trap designed specifically for the retail investor trying to participate. SpaceX is reportedly allocating 30% of shares directly to retail investors. That is 3 times higher than the standard allocation for a mega-cap listing. They are opening the floodgates for regular people to buy directly into the hype. But now remember everything we just told you. Fast entry, 4.2% float. When you combine retail hype with billions in forced mechanical index buying and compress it all into a 4.2% float, something breaks. You get a recipe for unprecedented, engineered market volatility in the opening days. The price action in those first 15 days will be historically chaotic. Retail investors will flood in on day one, chasing the historic $2 trillion valuation. Tesla took 3 years to enter the Nasdaq 100 after its IPO. SpaceX takes 15 days. On day 15, the automated index funds execute their forced mechanical buy orders. This creates a classic front-run and exhaust pattern. Spike, peak, collapse. Who wins in that scenario? The insiders holding that 95.8%. Who absorbs the cost? The everyday passive investor whose fund bought the top. Your index fund is algorithmically forced to buy at the highest point of the spike. This is not an accident. It is the architecture of how modern capital actually operates. When you understand this architecture, you stop playing the game they designed for you. You stop depending on your labor to generate the wealth you are actually capable of. And you start acquiring your own systemic assets, your own slice of the machine. Build a business, buy equity, own digital infrastructure, choose the other side. You must move from the side that is forced to provide the liquidity to the side that legally commands it from the structure of the market itself. The SpaceX listing is historic, not because of rockets, because of what it reveals. It is the greatest live demonstration of the asset monopoly in modern history. Watch the markets in the coming weeks. Watch the forced selling of Apple and Nvidia. Watch every index provider bend its own rulebook to accommodate true systemic scale. And ask yourself one question. Are you building a resume or are you building a system? This has been Finalystic Media, the data-driven breakdown of modern wealth mechanics. If you want to understand how the top 0.01% actually operate, hit subscribe and join the transition from labor to ownership.